Welcome to the Wilber and Longenbaugh podcast, where we break down tax, accounting, and financial strategies to help businesses stay compliant, profitable, and prepared. Imagine paying a $50,000 success penalty to the IRS this year just because you bought a new piece of heavy machinery in January instead of December.
Oh, yeah, that January versus December mistake is just, well, it's painfully common.
Right. So today we are taking a deep dive into why even the smartest, the most established business owners routinely make these incredibly costly tax errors, and how you can shift from that last-minute panic to actual proactive planning and risk reduction.
Yeah, because we tend to assume that tax mistakes are just for struggling startups.
Yeah,
But I mean, as a business scales, the transactions get more complex.
because they get way more complex.
Exactly. And the blind spots actually get vastly more expensive.
So before we even look at the complex corporate restructuring stuff, we have to look at the root cause, right? Which is how you manage time and data.
For sure. Time is the big one.
Right, because a lot of owners wait until April to plan for the previous year. I mean, to me, it's a bit like cramming for a final exam the morning of the test, except this test dictates your entire livelihood.
That's a great analogy. Except in this specific class, the professor grades you based on the notes you took like 6 months ago.
Oh, wow. Yeah.
If you didn't write them down then, you failed today. By tax season, the window for action has completely closed.
The year's already over.
Right. Your everyday choices throughout the year, when you buy equipment, who you hire, how you do retirement contributions, those are the levers that actually dictate your tax outcome.
And you just can't pull those levers without clean data. I mean, if your bookkeeping is a mess of incomplete records, you aren't just risking an audit.
No, not at all.
You are basically flying blind and volunteering to lose deductions.
Volunteer is the right word. When you don't have organized records, you just lose the ability to capture those deductions as they actually happen. You need real-time data to make strategic moves.
But that chaotic bookkeeping doesn't just cause a year-end cash crunch, right? It actually blinds you to what happens when the business suddenly scales.
That's the real danger right there. The root of that bad data is often just mingling finances.
Like mixing personal and business funds.
Yeah, or even mingling funds between two different corporate entities.
Okay, wait, let me stop you there. I mean, I get why a 22-year-old freelancer might pay for a personal expense out of a business account. But established, successful owners,
Well, they do it all the time.
why are they still mixing funds? Isn't that just a rookie mistake?
You'd think so, but it's because they are moving fast. An owner might casually fund a new subsidiary or, pay a major contractor out of the wrong corporate entity because the cash was just sitting there.
Ah, and they just needed to close a deal today.
Exactly. They tell themselves, oh, I'll sort the accounting out later. But structurally, doing that pierces the corporate veil.
Yikes.
Yeah, you instantly ruin your tax shielding and your liability protection.
And I guess by muddying the waters like that, you lose track of your actual net income across those entities, which inevitably means what, you miss your quarterly estimated tax payments?
Right on the money. Your revenue spikes, you miss the quarterly payments because your books are tangled, and suddenly year-end hits.
And you have a massive surprise tax bill.
Yep, you are bleeding cash to pay a bill you didn't see coming.
So the business basically just rapidly outgrows the owner's original tax strategy. I hear CPAs say all the time, call us before you do anything.
We do say that.
But as an owner, I make 50 decisions a day. I mean, I can't call my tax pro every time I order office supplies. What is the specific trigger point? Where is the actual line?
Okay, so the rule of thumb is this. If a decision fundamentally alters your cash flow, your head count, or your asset list, you make the call.
Head count, cash flow, assets, got it.
Yeah, like buying heavy equipment isn't just an operational expense. It unlocks Section 179 depreciation. If you time that purchase in December instead of January,
Like we mentioned at the start.
right, you wipe out a massive chunk of your current year's taxable income. Asking questions before major decisions gives you the flexibility to use those mechanisms.
And asking after just results in expensive corrections. So basically, business success absolutely does not guarantee tax efficiency.
Not at all.
Building reliable financial processes requires consistent, real-time bookkeeping, year-round planning, and proactive advice.
Because knowledge only protects you when you apply it in advance. Prevention is always, always cheaper than a retroactive fix.
Which leaves you with this final thought to chew on. What would your business look like if you stopped viewing tax planning as a required compliance chore and instead treated it as a primary strategic growth tool?
That's a huge mindset shift.
Right. Imagine taking the massive capital saved from a perfectly timed deduction and using it to fully fund your next key hire or acquisition.
I mean, that completely changes the trajectory of your growth.
To learn more about tax planning, accounting, and business advisory services, visit www.mwwcpa.com. Thank you for listening, and we'll see you in the next episode.